My name is Reil. If you're new to the channel, welcome. If you're not, welcome back. Today we're going to be talking about the stock portfolio of Cathie Wood and her company ARK Invest, taking a deep look into each of the top 10 holdings and then ranking them from best to worst in my own personal opinion. Cathie and ARK Invest have become famous for their investments into disruptive innovation, simply defined as technology that has the potential to change the way the world works. Since ARK Invest offers multiple ETFs, today we're just going to be looking at their most popular one, their Innovation ETF, ticker symbol ARKK. Currently trading at $53.54, this ETF is managed by Cathie Wood herself. It has $1.86 billion in net assets under management and is invested in 35 to 55 mid-cap to large-cap stocks. But today we're only going to be looking at the top 10, starting from the smallest and working our way up to the largest holding. Also, before we get into this video, I just want to say a major thank you to everyone who has supported this channel. We recently hit 1,000 subscribers, and I just wanted to say thank you for all your support. I'm still working to find my own style of videos, so if you see something you enjoy or you want to see more of it, then hit the like button on that video or leave a comment saying so. I look forward to making more videos and learning with you guys. Anyways, let's get into it. Starting with the 10th largest holding, currently making up about 3.06% of the portfolio, is Intellia Therapeutics, ticker symbol NTLA. The stock is trading right now at $12.30 with a market cap of $600 million. Intellia is a company in the genome editing field, using CRISPR or Cas9 to cure genetic diseases and to create new cell therapies for autoimmune diseases. The goldmine for this technology is a potential cure to cancer. However, this cure isn't yet attainable. A lot more research needs to be made before that point, but the field is advancing rapidly. This technology is at a point right now where they're discovering cures for novel, life-threatening diseases. In targeting these serious diseases, they'll have patients who are willing to pay for these very costly procedures. Doing this allows them to develop the technology and decrease the price of treatment, all while being self-funding. Similar to how Tesla started with a sports car while the technology was still expensive, but then brought it to the mass market as the cost of production decreased. Despite making $40 million last year, Intellia is still not profitable, recording a net loss of $56 million. Their revenue has climbed by about 37%. However, their expenses have also seemed to increase with it. Intellia currently has about $285 million in cash, giving them enough of a float where they can fund their own research in the event of a market dip. Overall, while I find this company and its potential for growth pretty promising, it's the price that's just a little too steep. It's currently trading at a 16 times price to sales ratio, almost triple the median ratio for the biotech sector. Each year, they're burning investors' money trying to keep up with their current work. If there's any delay, then it could spell bad news for the company. There's just a lot of risk here and no clear timeline for a payout. So for the time being, I'm going to rank Intellia in the number 5 position. Next up is Protolabs, ticker symbol PRLB, the 9th largest holding that makes up about 3.21% of the ETF. Currently, the stock is trading at $93.81, with a $2.5 billion market cap. Protolabs specializes in rapid prototyping and low-volume production. They use 3D printing and a variety of other new methods to get this done. Their entire business is built around the fact that they're able to get you your prototype manufactured and delivered faster than anyone else. As of recording this video, Protolabs has a net income of $64 million and is trading at about a 40 times price to earning ratio. When I went to their investor page and looked around at some of their presentations and growth plans, this is what I saw. To summarize this page, they pretty much plan to sell to more people, sell more parts, and offer more services. Now maybe I'm missing the picture, but it doesn't seem like the company deserves this valuation. Perhaps they're able to get more customers, but they're also going to come into more competition, and with that, falling profit margins. I think that 3D printing companies will be a lot like MJ companies. Initially, there was a lot of excitement and very few companies that led the pack. But as time went on, it became very apparent that it was really just a commodity, and that it really just came down to who was the cheapest. I don't think there's enough of a competitive advantage to protect this company and its valuation. Because of this, I'm going to put Protolabs at the bottom of the list for now in the number 6 position. Next, the 8th largest holding, making up 3.51% of the portfolio, is Roku, ticker symbol ROKU. Currently, the stock is trading at $112 with a market cap of $13.3 billion. Roku is one of the more recognizable brands on this list, being known for their streaming devices and their streaming service. Roku is similar to Netflix in its function, but one key difference sets them apart. Netflix is currently moving their library towards new content that they charge monthly for. Roku's library is almost entirely made up of content that is older than 5 years. Roku also has a free version of their streaming service that has ads, letting them scoop up the part of the market that Netflix and competitors left on the table. This model has allowed for a profit margin of 44% and a 52% revenue growth in 2019. However, this high revenue growth is starting to slow down. Analysts are estimating a 42% growth in 2020 and a 33.6% growth in 2021. It's still going to be high, but it will be slowing down just a little bit. In addition, they're also going to be projecting that Roku will remain unprofitable all the way up to 2021. The underlying company looks pretty solid. However, I'm skeptical of how secure Roku's future is. The model that they have can easily be replicated by competitors who all have other aspects to their business and are more protected, like Netflix. Netflix has Netflix originals, and YouTube has a huge platform of creators. There's just nothing about this company that's going to stop them from losing a large share of their market to competitors. Currently, Roku is trading at a 13 times price to sale ratio, which is much higher than the sector average of 1.6. Now, I don't think that Roku is a bad company. I think they have a good model and their own place in the market right now. However, I don't think they should be trading for what they are right now, just given how difficult growth in the future could be. So for now, I'm going to rank Roku right above Proto Labs, but just below Intellia, in the number 6 spot. Next, making up about 3.67% of the portfolio is 2U, ticker symbol TWOU. Currently, the stock is trading at $22.97, giving them a market cap of $1.5 billion. 2U is an online education system that partners with universities to offer online programs to students anywhere. 2U was actually a very hot growth stock a couple years ago. However, after reaching its peak share price of $98, it became clear that there was just too much competition to warrant that valuation. Since 2U lowered guidance, the stock price has been in freefall, currently down about 75% from its peak. 2U has never been profitable, and from the looks of it, they won't be anytime soon. Analysts are projecting 28% growth for 2020 and 16% growth for 2021, a far cry from the 40% that investors were hoping for. At the moment, there's just too much competition in the online education market to sustain those high margins. And while it was a good idea initially, there's just nothing that protected their share of the market. I personally don't see the stock coming back anytime soon, so for that reason, I'm going to put 2U at the bottom of the list. The next stock is one that I'm personally pretty interested to learn more about, and that is CRISPR Therapeutics, ticker symbol CRSP. This is the 6th largest holding that makes up about 4.67% of the ETF. As of now, the stock is trading at about $50.88, giving them a $3.1 billion market cap. CRISPR Therapeutics is another genome editing company, very similar to Intellia, and since I already talked about how genome editing companies have the potential to become these huge gold mines, I'm not going to repeat that. At the moment, it seems like investors seem to like CRISPR Therapeutics more than they're liking everyone else. This is most likely because they are the fastest to advance to clinical trials, a huge step in any of these companies realizing their valuations. Like Intellia, CRISPR's revenue is all over the place. This isn't much of a problem, however, because they're still very clearly in the development stage. You likely won't be seeing any stable revenue for a few years. CRISPR did end up seeing a huge surge in sales this year because of a one-off deal with Vertex Pharmaceuticals, giving them about $105 million in cash. In addition, this also opened them up to receiving potential future royalties. With almost no debt and a stockpile of cash, CRISPR is looking pretty good. CRISPR is currently one of the most promising gene editing companies out there, and because of that, I'm going to put them at the top of the list right above Intellia, in the number 4 position. Next up, and marking the halfway point, is Stratasys, ticker symbol SSYS. They're currently making up about 4.7% of the ETF. As of today, the stock is trading at $17.44 with a $925 million market cap. Surprisingly, this stock has been trading at about that level since about late 2015. It was around this time that it became clear that the market for 3D printing had been taking a lot longer than expected to become common practice. Stratasys has not really seen any revenue growth since 2016 and has been consistently losing money every year. However, analysts are predicting that things might start to change in the next few years, projecting a 9% growth rate in 2020 and then a 36% growth rate on average over the next 5 years. This is a very optimistic outlook, considering that there will almost certainly be more competitors in this space if it is to grow. Stratasys primarily provides entry-level 3D printers and some production printers. While they do have a decent price-to-sale ratio of 1.67, the biggest problem I have with this company is just that there's no barriers to protect them. There's no clear long-term competitive advantage they have that their competitors can't just replicate. I think that an investment into Stratasys is pretty much the same as just an investment into 3D printing. It'll perform about average and grow with the market. They may be able to become profitable in the upcoming years, and if I was looking to invest in 3D printing, then I'd personally go with probably Protolabs over Stratasys, which is why I'm putting Stratasys right below Protolabs. However, I do plan to keep an eye on this company and research it more since it is trading at a pretty good valuation, so there might be something there. Next is their 4th largest holding, which makes up 6.35% of the portfolio, and that is Illumina, ticker symbol ILMN. Currently, the stock is trading at $275 with a $40.4 billion market cap. Since going public, Illumina stock price has been trading with a fairly consistent upward trend. Illumina is another DNA tech company. However, unlike some of the other ones on this list, Illumina is primarily focused on DNA sequencing. Their mission is to map and understand the genome to help identify disease-related genes, where companies like CRISPR and Intellia are not only focused on understanding the genome, but also developing a system to edit it. Illumina has seen very solid growth over the past couple of years, and investors are expecting that to continue. Seeing that they have a more stable growth compared to some of their competitors is one of the big reasons that investors are willing to trust them. In addition to this, the best part about Illumina is that they've actually managed to be profitable for quite a long time now, reporting a net income of $1 billion last year. At the moment, it looks like Illumina is the most stable and safe bet if you're looking to get involved with DNA stocks. They've been taking a very different approach than other companies, and it seems to have paid off for them. With Illumina's track record in their current position in the market, I think that they show a lot of promise for the future. However, other investors seem to think so too, which probably explains why their stock trades with a 41 times PE ratio, 19% higher than the sector median. So given all this, I'm going to put Illumina at the top of the list, right above CRISPR, in the number 4 position. Alright, so we are down to the final 3 now. And making up 6.82% of the ETF is ARK's 3rd largest holding, Invitae, ticker symbol NVTA. Currently, the stock is trading at $20.75, with a $2 billion market cap. Invitae is yet another company in the genomic sector. However, Invitae is built around testing for genetic diseases in the real world. This is a huge section of the market that can be extremely profitable. If they manage to make it easy and cheap to get tested for any genetic risks, then this could have a huge effect on the way our current healthcare system works. Currently, Invitae has been seeing a very high revenue growth, averaging about 40 to 50% each year, and analysts are expecting that to continue in 2020 and 2021. Despite this growth, Invitae has not yet been profitable, recording a net loss of about $240 million in 2019. Currently, they're trading at a price-to-sale ratio of 10.4, very similar to where CRISPR is at. Despite this future predicted growth, they're still expected to remain unprofitable in the near future. Overall, I think if you're looking to make a speculative investment, you'd be better off just going directly with a company that does genomic editing. Any company can start doing genetic testing, but not every company can develop and patent a cure for a previously incurable genetic disease. Because of that, I'm going to rank Invitae right below CRISPR Therapeutics. When comparing the two, I just think you get more bang for your buck going with CRISPR. Coming in as the second largest holding in the ETF, making up about 7.3%, is Square, ticker symbol SQ. Currently, Square is trading for $76.60, with a market cap of $33 billion. Square's built its business around payment and point-of-sale solutions. Square's also been working to build an online ecosystem for their merchants, allowing them to manage all their financials in one space. In addition to this, Square has been pushing to become the largest payment processing system to accept cryptocurrency. This could be a pretty big opportunity for Square in the future if things play out that way. Square is also looking to build their market share in other financial services by owning various apps and services. The most notable right now for me is Cash App. Square has yet to post a profit. However, when you look at their revenue growth, you kind of forgive them. In 2019, Square saw their revenue grow by 45%. Now, when you compare that to PayPal's revenue growth of 15%, Square's looking pretty good. Square is also expected to keep up that growth rate, with analysts projecting an average annual growth rate of 38% over the next 5 years. The way I see it, it looks like Square could become profitable at any time they want. But instead they're choosing to reinvest everything back into growing their business. And if you're investing in a growth stock, that's kind of what you want to see. You want a company that could be posting profits, but is instead using that money to do exactly what they said they were going to do, grow. Having demonstrated their ability to execute and having clearly outlined their plans for their future growth, it gives investors a reason to be confident when investing in Square. Because of this, I'm going to put Square at the top of the list in the number 2 position. And finally, the number 1 holding on our list, Tesla, ticker symbol TSLA. They make up about 9.98% of this ETF. They would probably own a little more, but they have to cut back due to regulations. Currently, the stock is trading at $778, with a market cap of $143 billion. This is the only stock in this list that I personally own. I actually managed to pick up about 90 shares back in late 2019 for an average cost of $265. As of recently, Tesla stock has been on an absolute tear, gaining about 200% since October, but wavering a little bit since the coronavirus. Now, I'm sure you know about Tesla already. They're leading the pack on EV production, autonomous vehicles, and renewable energy production and storage. And they even plan to take on Uber and Lyft with a self-driving robotaxi fleet. Tesla is currently trading with a high valuation for where their sales are right now. However, analysts are expecting this fairly high revenue growth to continue going forward, projecting 33% growth for 2020 and 27% for 2021. This is all while competitors are actually reporting losses. Now, I'm not going to talk too much about Tesla. If you want to see a full video talking about their growth potential, then click the card somewhere on the screen. I personally believe in Tesla the most out of any of these companies, and I trust in their ability to execute. And for that reason, I'm going to rank them number 1. So that completes the list for the 10 largest holdings in this ARK Invest ETF, as well as my personal ranking for each of them. I'm personally a fan of the whole disruptive innovation niche that ARK Invest has become known for. However, pretty much every stock in this ETF is very, very speculative. And while I have nothing against investing in the future, and I actually try and do that myself, there just tends to be very few high quality stocks that are out there with a solid foundation for growth. Anyways, all this is just my opinion. If you disagree with my ratings on these stocks or want to leave your own reasoning, do it in the comments. I'd love to hear what you guys think of my overall ranking. How would you rank these 10 companies? Leave a comment below. I read each and every one. I hope you enjoyed this video as much as I did making it. If you did and you want to support the channel, then make sure you click that like button. And if you want to see more videos, click the subscribe button. Anyways, I'm Will, and I'll see you later.